Welcome back to The Explainer. Today, we are getting into a complete paradigm shift for trading markets like Bitcoin and gold. We're tossing out those old textbook definitions and looking right under the hood at how smart money actually operates. So, if you're ready to stop trading like the masses and finally figure out the true mechanics behind price action, well, you're exactly where you need to be.
Seriously, think about this for a second. How many times have you perfectly timed a level, you bought that obvious support, or you shorted the resistance, only to get instantly taken out by a sudden, violent wick? You're just sitting there, completely frustrated, staring at a loss. And then, what happens? Literally, 5 minutes later, the market sails perfectly in your original direction. I mean, it is infuriating, right? Okay, let's dive into this, because I promise you it's not just bad luck. It is purely market mechanics. And the whole thing starts right here, with this one foundational concept. The market doesn't trade lines, it trades zones. You see, retail traders absolutely obsess over exact pixel-perfect lines drawn on their charts. They genuinely think a specific dollar amount is some kind of magic brick wall. But here's the thing. Institutional smart money, they do not care about your thin little line. They have massive orders to fill, and they operate within broader, thicker zones to get that done. Once you shift your thinking from thin lines to thick, highly reactive zones, honestly, your entire perspective is going to change. So here's our roadmap for this explainer. First, we'll cover the retail breakout trap. Then we'll move into mapping true price zones. After that, we'll hit liquidity and stop hunts, followed by a step-by-step trade setup. And finally, we'll wrap it up with risk management and psychology. Let's get right to it.
Section 1, the retail breakout trap. First things first, we really need to unlearn the highly flawed methods most of us were originally taught. Just look at the stark contrast between the retail mindset and the smart money mindset. Retail traders are out there buying obvious breakouts, they're trading exact thin lines, and they're reacting totally purely on emotion when a trade goes south. Smart money, on the other hand, trades entire zones. They patiently wait for stop sweeps, and they rely on volume or footprint confirmation. Seriously, if an 80-year-old grandmother can look at a chart and spot an obvious breakout line, yeah, the reliability of that level is basically zero. If it's that obvious to literally everyone, it's a trap just waiting to be sprung. Now, what's really fascinating about this dynamic is the sheer scale of the disparity. 95% of retail traders are losing money, while only about 5% win consistently. I mean, just think about the logic here for a second. If 95% of traders are losing, why on earth would we want to do what they do? If the masses are panic buying a painfully obvious breakout above a resistance line, following them almost guarantees failure. We literally have to trade the exact opposite way. Because at the end of the day, where there is retail pain, there is smart money gain.
Moving on to Section 2, mapping true price zones. So, if we aren't drawing those obvious thin little lines, what exactly are we doing? Well, to understand zones, we have to understand auction theory. It's kind of like the housing market. Imagine a house goes for $200,000, then it goes for $300,000. Finally, someone steps up and pays $400,000. Let's call that month 1. But by month 2, nobody else out there is willing to pay $400,000 or higher. The buying volume just completely dries up. So by month 3, you have passive sellers listing their houses at $400,000, but there are 0 aggressive buyers left to take them. The sellers overwhelm the buyers and the price drops. That exact exhaustion of buyers, that's exactly how a resistance zone forms on a chart. Whether you're looking at real estate, Bitcoin, or gold, the market moves up until the absolute last buyer buys, and then it just has no choice but to reverse.
Now, when you're looking at a chart, whatever you do, don't just mark every single swing high or low. Actually, scratch that. If you do that, your chart's going to end up looking like a confusing prison of useless lines. Instead, you want to use a specific checklist to find true zones. First off, look for sharp, impulsive past reversals. Price shouldn't chop around. It needs to reject hard. Second, look for multiple touches defending the level. Third, it needs to be visually obvious without you having to squint. Seriously, if you're hunting for a level in all that lower time frame noise, it's just not strong enough to trade. And finally, recency. A level from last week on the 4-hour chart matters way more than a daily level from 3 years ago.
All right, Section 3, liquidity and stop hunts.
Now we're getting into the really fascinating stuff. This is the hidden game happening inside the charts every single day. The liquidity game is basically the deliberate sweeping of an obvious support or resistance level to trigger a massive cascade of retail stop losses. Why? Well, because the big institutions need massive liquidity to fill their huge orders. So the absolute crucial point here is this. Your perfectly placed stop loss, the one tucked neatly 5 pips underneath a support line, it's actually someone else's entry ticket. That perfectly obvious support level wasn't a floor at all, it was a target. Trust me, the big players know exactly where you hide your stops. The prime danger areas they target are previous day highs and lows, big round psychological numbers, and those painfully obvious double bottoms or higher highs. But knowing this, your entire strategy completely flips. Instead of buying at these obvious levels and dropping your stop right where everyone else does, you wait. You sit back and wait for the price to aggressively wick through the level, sweep those stops, and show a strong rejection before you even think about entering. Basically, you let the trap spring on everyone else first. Let's transition into Section 4, Step-by-Step Trade Setup. Okay, we've got the theory down, now let's turn this into actual execution. Here is your 4-step playbook. Let's say you're trading Bitcoin. Step 1. Identify extreme swing highs and lows on a higher time frame, like the daily or 4-hour chart. Step 2. You mark the broad zone where price reacted, not just the absolute tip of a single wick. Step 3. Watch for price to test that zone and look for that liquidity sweep, the fake out we just talked about. And step 4, this one is absolutely critical. Never enter just because the price touched your zone. You have to wait for volume to confirm the reaction or for a market structure shift on a lower time frame. Remember, your edge comes entirely from waiting for the trap to spring on those impatient traders. Another thing you really want to keep an eye out for is called the flip, otherwise known as role reversal. And honestly, this is one of the highest probability events in all of trading. Let's say a strong support zone finally breaks down. Well, all those retail traders who bought that support are suddenly underwater, and they are desperate to just exit at break-even. So when the price eventually rallies back up to that old support level, those trapped traders aggressively sell just to get out. That organic selling pressure naturally turns what used to be a support floor into a brand new resistance ceiling. It's beautiful to watch. And this perfectly illustrates exactly how we use volume to avoid getting tricked by fake breakouts. Let's say you see price break a major gold resistance zone, but it's on super low volume. That tells us there's weak participation. Nobody big is actually committing capital. It's almost certainly a trap, so you just wait and look to fade the move back into the range. But on the flip side, if price breaks a zone and volume absolutely explodes, well, that is real demand. That is smart money committing. And in that scenario, you ride the breakout. Basically, the chart shows you what happened, but the volume tells you if it actually meant anything. And that brings us to our final part, Section 5, Risk Management and Psychology. Frankly, you could have the most accurate zone analysis in the world, but it's completely useless without the discipline to treat it correctly. So here are your rules for bulletproof risk management. First, your stop loss has to go safely beyond the sweep wick. If you place it tight under an obvious line, you are literally asking to be hunted. Put it outside the absolute boundary of the entire zone. Second, never enter a trade when the price is just chopping around inside a messy zone. If the market hasn't picked a direction, neither should you. Third, always reduce your position size near those high volatility levels. And fourth, trust confirmation, never predict. Don't guess that a zone is going to hold, wait for the market to prove it with a strong, undeniable reaction. All of this builds up to the ultimate trading psychology, which is simply patience over prediction. Your job isn't to perfectly forecast the market with a crystal ball. Your job is to be the silent observer who spots the non-obvious traps right before they spring. When everyone else is emotionally slamming the buy button on a fake breakout, you are just sitting on your hands, watching the volume, waiting for the inevitable stop hunt, and ready to enter safely the exact moment the smart money shows their hand. So I want to turn this over to you. Knowing everything we've just covered about liquidity games and smart money zones, what's your play? Do you prefer trading those sharp bounces right off support and resistance? Or do you actually have the patience to wait for a confirmed high-volume breakout trade? Think about how these mechanics are going to influence your charts the next time you boot them up. Thanks so much for joining me on The Explainer today, and remember, keep mastering those hidden zones.